Hello, everyone, and welcome again to Nettle, the best platform around for distance learning in business, finance, economics, and much, much more. Please don't forget to subscribe to our channel and click that bell notification button below so that you never miss fresh videos and tutorials you might be interested in. Many thanks to our current Patreon supporters for making this video possible, and we would also greatly appreciate if you consider supporting us as well, so please check the link in the description for more details. My name is Sava, and today we're investigating the new standardized approach for operational risk measurement. That is what Basel Committee for Banking Supervision requires systemically important financial institutions, that is, big banks, to calculate to proxy their operational risk exposures and how it translates into their operational risk capital charge. And the most important concepts in this regard are the business indicator and the internal loss multiplier. And today we'll discuss in great detail both. We already had a video on the new standardized approach last year, but today we are digging a little bit deeper into the internal loss multiplier calculations and how to best approximate it with banks' own reports on its operational losses, on operational loss events. And we're also considering some potential changes that might soon arrive to the Basel methodology. And our main hero today is Barclays, as usual, and we will be calculating all of the proxies based on Barclays 2019 annual report and Barclays 2019 Pillar 3 disclosure. And the methodology on which we're basing our calculations is taken straight out of Basel's documentation on the new standardized measurement approach for operational risk. The key centerpiece of operational risk calculations is the business indicator. And the business indicator is a synthetic concept that aggregates disclosure elements from three business lines that are defined as interest, lease, and dividend component, ILDC for short, the financial component, FC for short, and the services component, SC for short. And it builds up on the concepts developed in the basic approach and in the old standardized approach, where you used operating income to proxy operational risk exposures, and you also acknowledged for heterogeneities in various business lines. However, what makes business indicator more objective and perhaps a better proxy for operational risk exposures is that it synthesizes the operating income generated by various activities more objectively in a way that makes it easier to calculate, reflect the nature of the operating capacity of the bank to greater extent, and what is most welcome for us as outsiders who try to calculate the proxies without access to disaggregated internal data, are almost perfectly compatible with disclosure items from the bank's annual report. So without further ado, let's try and calculate the business indicator using Basel's own formulas and Barclays disclosure. Most of the disclosure comes from Barclays consolidated income statement, which is reported on page 241 of their 2019 annual report, and you can always find the consolidated income statement in any report of any bank you encounter, so this should be a no-brainer. For the interest, lease, and dividend component, we need to figure out what is larger at first. The net interest income of the bank, so interest income minus interest expense, both can be retrieved from the consolidated income statement, or the interest earning assets of the bank times some proxy of the interest margin of 3.5%. That makes sure that the business indicator does account for the interest component of operational risk, even if the bank has very low interest margins or even loses money on its interest activities. So here we take whichever is larger, the net interest income of 3.5% times the interest earning asset stock, and this figure is a little bit harder to retrieve, and you can see it, you can spot it at various places at your bank's disclosure. For some banks, this figure would be disclosed at the very start of the report as one of the key metrics, but for Barclays, it can be presented at the margins analysis section, where Barclays reports its interest margins. So here they have got clients' asset that yield interest, and that would be a very good proxy for interest earning asset stock that we take for our calculations. And then we need to consider that the lease income component is actually, as per the International Financial Reporting Standards Barclays abides by, accurately reported within interest income and interest expense, so we don't need to worry about them in that case. And the dividend received, the dividend component, can be taken from page 247, which is the cash flow statement. At the end of the cash flow statement, Barclays does report how much in dividend has it received throughout the year. So that is also covered from quite basic disclosure elements. That's ILDC all over and done with. So what about the financial component? The financial component is the sum of the absolute values of trading profit and non-trading profit, and this can be also retrieved from the consolidated income statement. For the net trading profit, we can go for the characteristics of the trading portfolios, so net trading income from the Barclays trading portfolio, and to get the net non-trading profit, we can just figure out the difference between the total net profit and the net trading profit, getting us towards the net non-trading profit, quite obviously. So net profit can be seen towards the end of the consolidated income statement. Here, as per Basel regulations, we need to take into account net profit before tax, as tax, as per Basel's methodology, cannot impact the business indicator, so net profit before tax over here, and we subtract the net trading profit from the trading portfolio characteristics to arrive at the net non-trading profit. And the financial component is just the sum of the absolute values of the two. And then we can calculate the unadjusted business indicator, that is unadjusted for the services component, by just combining the ILDC, the interest, lease, and dividend component, the financial component, those two we have just calculated, other operating income, gotten straight out of consolidated income statement as well, page 241 in Barclays 2019, and the maximum of either fee income or fee expense of the bank that is also reported there at the same disclosure category. However, to calculate the services component and to finalize our business indicator calculations, we'll need to adjust our business indicator. What is the logic of this quite complicated at first adjustment procedure? Well, the logic here is to figure out whether fees play a substantial role in generating the operating income of a bank. So here we get the maximum of either our absolute net fee income or this synthetic expression that relates the unadjusted business indicator and the maximum of the fee income or fee expense. So here we need to make sure that we fall in this sweet spot where we are not over-relying on fee expense and fee income in calculating our business indicator, but we are not underestimating the impact of fees that generate some nice cash flows for our bank. And this is in place to provide for varying business models of various banks. Some of them can implement a more traditional business model relying on interest income mostly, and some can be more digitalized and rely on fintech applications, and that would most likely be reflected in greater values of fee income and fee expense. So to provide for this wide range of various business models, this adjustment procedure is used to calculate the services component. And then we can sum up the three components we have just calculated and get our value of the business indicator. And here you'll see these formulas translated into the language of Excel. Again, nothing too complicated. The only caveat you need to keep in mind is that, as with the basic approach and the old standardized approach, all of these items are calculated based on 3-year averages. So all of these disclosure items would be averaged over 3-year periods up to the most recent annual report. So for 2019, you would average over 19, 18, and 17 figures, and that is the case for all of disclosure items. Then the financial component is again the sum of the absolute value of average trading and non-trading profits, calculated again from consolidated income statement data. Then the unadjusted business indicator is quite straightforward. You just add the maximum of fee income and fee expense and adding up other operating income. And then the services component would be taken straight out of this formula. And then finally, we can arrive at our business indicator in the currency of reporting. And as Barclays reports all of its disclosure items in million pounds, that would be our business indicator in million pounds. Another quite Europe-centric aspect of Basel, well, Basel is in Europe, isn't it? That all of the thresholds for the business indicator are reported in million euros. So we need to convert our business indicator into billion euros using some GBP euro exchange rate, and here it would give us 28 billion euros. And then we need to look at which bucket does Barclays fall into. And those buckets are formed based on the business indicator in billion euros. So the smallest bucket would be business indicators less than a billion euros, and for those banks, the internal loss multiplier is actually not required. You can just calculate your operational risk charge based on business indicator alone. It reflects the fact that smaller banks might struggle with keeping records of operational loss data for their bank in particular, so it's a little bit lenient from Basel side, quite untypically of them actually. And then the formulas of the calculation for the business indicator component differs. It's just a linear function with an over increasing slope, as we can see over here. It differs from bucket to bucket. So this function is calibrated so that it's continuous and that its slope increases when you move from lower buckets to higher buckets. That reflects the fact that for larger banks, major operational risk events are more prominent, so operational risk exposures for larger banks could take a higher chunk of their operating income. And we can see that Barclays doesn't actually quite qualify for the highest bucket, which is again good news for Barclays, perhaps, in terms of operational risk capital charges. It means that they need to calculate their disclosure based on the fourth bucket formula. And here it is, so we can just use the VLOOKUP to check which bucket we fall into and retrieve the business indicator component from this particular bucket. And then we convert it back to pounds to make sure that we stay in the reporting currency of our bank. So again, this double conversion from pounds to euros and then from euros back to pounds is just what you need to do, you have to do, simply because Basel reports its thresholds in euros. That there is no way around it. However, it's not yet enough to get our business indicator component, either in euros or in pounds, to calculate our operational risk capital charge. Again, if we are in bucket 1, that would be enough, but we're in bucket 4, so we need to calculate our internal loss multiplier as well. And there is no way to calculate the internal loss multiplier as per the Barclays, as per the Basel methodology, than to use internal operational loss data. And that is something that is inherited from the advanced measurement approach that was phased out after it was realized that it's too complicated for both banks and regulators to understand and implement without any shortcomings. So the methodology was simplified, but the remainder of this advanced measurement approach that required banks to keep track of their internal loss data and use it for their calculation of operational risk measures is that internal loss multiplier uses this loss data in its calculation methodology. So where to find the data on operational risk events for your bank, and how to proxy the internal loss multiplier based on that? Well, for most banks, you would find them in the section called either Risk Performance or Risk Review, Operational Risk, and it's page 200 in 2019 report. And for Barclays, it's precisely called Risk Review, Operational Risk. But if you find that this data is not enough for you to calculate these figures, then you can resort to the Pillar 3 report, where this data would also be provided. So consider both and take figures from either of the two where data is presented in greater detail. And here we see that we have got it for 6 years, from 2014 up to 2019. So we actually had to survey quite a lot of various reports, as one report typically covers figures from this year and the previous year. So actually you can go to 3 reports, 2019, 2017, and 2015, and get data for 6 years straight away. Another caveat is that the number of events is only started to be recorded from 2016. Before that, what Barclays reported is just the rate of increase or decrease of operational risk events, so the number of loss events they keep track of. So to avoid that and get a figure on the number of operational risk events, you can just account for that by using your growth rates to interpolate from 2016 figure. And this is how you can extend the sample, the number of years you take into account by using imperfect disclosure elements that your banks provide. So be creative, be resourceful, and don't give up. Even if you cannot get the exact figure, you can always estimate it using some secondary disclosure items banks end up providing. So what we can see here straight away is that the number of events, number of operational risk events throughout the years is decreasing quite steadily, which perhaps emphasizes how much more robust Barclays has become in terms of operational risk management throughout the years. However, the total losses, while decreasing, not decreasing that steadily. We can see that, the dynamics is quite unstable, with losses being the highest in 2015. They also exceeded £300 million in 2017 as well, but they are quite low in 2019. So while the number of events is decreasing steadily, the number of losses is fluctuating quite a lot throughout the years. This is the logic that Basel acknowledges when requiring the banks to use multiple years worth of data to calculate the internal loss multiplier. The best case scenario would be to get 10 years worth of data. That's the requirement Basel puts there quite clearly. But if you got no data for 10 years, 5 years or higher would be enough. And here, as we didn't go back to 2013, 2012, 2011 and 2010 to get 10 years worth of data, we'll do our calculation based on 6 years. And that's perhaps a source of disagreement between our capital charge that we'll calculate based on proxies and the real capital charge that Barclays reported themselves in their Pillar 3 report. And here, the calculation that we need to do should reflect the distribution of losses, not only their magnitude. And this can be evident from the loss component formula. The loss component that you then factor into your internal loss multiplier is 7 times your average annual loss across all events, plus 7 times your average annual loss taking into account events that lost you more than 10 million euros each, plus 5 times annual loss factoring in only the most extreme events that resulted in a loss of more than 100 million euros each. So here, Basel tries to proxy the heaviness of tails of your operational loss event distribution, and this is quite a simple structure that banks can use when they have data event by event. However, we haven't got that. We only have got data on the number of events and total losses. How can we estimate how many events of various magnitude occurred throughout the years? Well, to do that, we can rely on these two figures that Barclays is actually reporting quite consistently over the years. This is the percentage of the number of events below £50,000 exposure. We can see that over 80% of such events in most of the years occurred with exposure below £50,000. And the exposure, so the amount of losses, the total amount of losses that was generated by such small events. And here we can see a very notable discrepancy. Well, events that lost Barclays lower than £50,000 each were dominant in terms of the number of events, more than 80%. Most commonly, they accounted for less than 20% of the total losses. And 80-20 is something that should remind you of the Pareto distribution. 20% of the most significant loss events at this very tail that the loss component tries to account for more than 80% of your operational risk losses. And that leads us to believe that maybe the operational loss events, so the losses that Barclays is exposed to from each and every single one of these events, is actually distributed according to the Pareto distribution, the power law distribution. So how you might proxy that, how you might model that? Well, we can calculate the average loss per event in $1 million across all events and across the events above £50,000 by just accounting for the fact how many of them there are and how much of the total loss they generated. But what we also can do is we can implement the Pareto distribution as a power law distribution over here. And it's quite handy that the Pareto distribution relies on some minimum value of x, some cutoff value of x, to generate a convergent distribution with a convergent expectation, with a convergent mean. In our case, it would be average loss per event. And it is again handy that we've got this cutoff value here, £50,000, because Barclays reports how many events there were above this cutoff point, £50,000, and which proportion of the losses these events have accounted for. So we now can actually retrieve the distribution shape of this tail of the loss distribution above £50,000 by using this logic, the method of moments, basically. Calculating the shape, the value of this parameter A, the shape of our tail, our power law Pareto tail, by factoring in the average loss above £50,000 and again retrieving the value of A from there. And we can see how it changes over the years and what is the value of this parameter on average across the whole 6-year record. And now, by using this parameter, we can actually factor it into this Pareto cumulative distribution function and get the probability of a particular loss event exceeding 10 million euros or 100 million euros. And to do that, we need to, again, convert these thresholds into pounds, again, by using some relevant exchange rate. So 10 million euros would be 8.55 million pounds, and 100 million euros would be 85.47 million pounds. So factoring these thresholds in, we can calculate the probability of an operational risk event exceeding 10 million euros or 8.55 million pounds in exposure. To get that, we first need to factor in how much of our events are above £50,000, so 1 minus 84%, only 16% of those events are above £50,000, and then plug in this value of the cumulative distribution function, as this value of the cumulative distribution function gives us the insight into what is the probability of the loss not exceeding some amount. The probability of the loss exceeding that amount would be this component, which is what is subtracted from 1 in the default case, and that's what we account for over here. So we can figure out that only 0.045% of all events across the whole 6-year history were exceeding 10 million euros, and less than 0.003% were exceeding 100 million euros. You can think of the LIBOR rigging case, 1 in a decade event that was, however, quite impactful for Barclays, needless to say. And judging by these estimated probabilities from our 6 years worth of data that we have calibrated using the Pareto distribution, we can figure out how many events of varying magnitudes there were by multiplying the total number of recorded events across all 6 years by these probabilities. And we can see that there were only 8 events, approximately, with exposure above 10 million euros and only 1 event above 100 million euros of exposure. And now we can calculate the average loss per event, provided that they exceed 10 million euros or 100 million euros in exposure. And here we use this function to get our conditional expectation. That's quite easy. We plug in our cutoff value, 10 million euros or 8.55 million pounds, there is, and multiplied by a divided by a minus 1, our shape parameter divided by shape parameter minus 1. And we do the same for our 100 million euro cutoff. And then we can calculate our total loss over here, so referring just to the sum of losses throughout the 6-year period. And the sum of losses originated from our proxied events above 10 billion euros of exposure and over 100 million euros of exposure. And then we can divide those by 6 to get average annual values. And we're good to go. We can finally calculate the loss component in pounds, 7 times average annual loss in total, 7 times average annual loss generated by events over 10 million euros in exposure, and plus 5 times average annual loss taking into account only the events over 100 million euros in exposure. Then we convert it into euros using the same exchange rate. Then we refer to our business indicator component in euros from this spreadsheet. And then we can calculate our internal loss multiplier by using this weird formula that uses the natural logarithm of the e, which is the exponent of 1, 2.7128, minus 1 plus the ratio between the loss component and the business indicator component. So the higher the loss component is, corresponding relative to the business indicator component, the higher our internal loss multiplier would be. So the logic is quite simple. The more losses you record, the more capital you need to reserve per the unit of your business indicator, per unit of your adjusted operating income across the 3 business lines. And finally, we can figure out our capital charge in euros and in pounds, and it's generated by this formula. Again, this formula is used for banks falling into buckets 2 and above. So bucket 1 would be just based on the business indicator without any internal loss multiplier calculations. But for Barclays that falls in bucket 4, we can calculate it as 110 million euros plus the business indicator component minus 110 million euros, and this difference should be multiplied by our internal loss multiplier. And we arrive at roughly 4 billion pounds of the standardized measurement approach operational capital charge, and this is quite close to the value reported by Barclays itself. The discrepancy can be attributed to the fact that we used 6 years, so 2014 to 2019, unlike 10 years recommended by Basel and 10 years that Barclays themselves use because they have access to disaggregated data on event level, and also by the fact that we used the Pareto distribution to proxy the occurrences of high impact operational risk events, while Barclays had these events recorded individually in their disaggregated dataset. However, there are also some developments that are proposed to the business indicator and internal loss multiplier approach that would change the formula from this weird formula with a natural logarithm to this much cleaner formula that uses a ratio. However, this formula includes a parameter m that Basel hasn't yet calibrated, and they are currently calibrating the value of this parameter to arrive at the best structure of operational risk capital charges to make them more consistent across banks and fairer to various systemically important financial institutions from various buckets, so of various sizes. And if we assume that this hypothetical parameter would be 2, we can calculate the new revised internal loss multiplier value. We can see that it would be quite similar to the one obtained from this formula, and calculate our capital charges as well. And that's how you calculate the operational risk capital charge using the new standardized approach with the business indicator and internal loss multiplier based on the operational risk event data for your favorite bank. Please leave a like on this video if you found it helpful. In the comments below, I'm eager to see any further suggestions for videos in business, economics, or finance you would like me to record. And please don't forget to subscribe to our channel or consider supporting us on Patreon. Thank you very much, and stay tuned.